And that's why, in my opinion, ultimately you'll see the ultimate outcome, which is probably honestly a 70%, 75% correction in NVIDIA over the next couple years.
You know what? Let's address some of the hater comments. One of the comments is you're early on your shorts, the timing is wrong, but you're still sticking to it. Your conviction is high. How do you respond to that?
Yeah, so the absolutely correct. So definitely early on it. I think that's part of being, a trader, investor. You see the future and you start positioning yourself ahead. Just a good analogy, or actually a good point. I had some people that I was trading money for back in '07. I warned them in early to mid '07 to be exiting the market in full. We didn't start to decline until early '08. And so I was about 6 to 8 months early there. I'm probably 6 to 8 months early here as well.
Gareth Soloway returns. He is a chief market strategist at verifiedinvesting.com and will be getting his monthly updates. Welcome back to the show, Gareth.
Hey, thanks so much, David. It's always great for me to be here. I love our conversations.
Yeah, wait, I love it when you're back. Lots to discuss since last time you're on. I want to start by talking about this divergence that's been happening between the S&P 500 sectors and the broader index since last time you were on. Since the beginning of June, Gareth, you can see that of the 10 sectors of the S&P, 8 of them have been diverging away from the S&P 500. I was telling you offline, the tech sector is the only sector year to date that's been beating the S&P. All the other sectors have lagged. In particular, the last month, you can see this really big divergence away from the main sector. I guess it's mainly driven by tech. What's your read on this? As a trader, what do you do when all the other sectors break away from the main index and the only sector that's kind of leading the pack and outperforming is tech?
Yeah, and this is something that's very concerning. And I'm going to show this screen here, this chart. This is the equal weight S&P versus the S&P itself. And what's so concerning here, and you just brought it up, is that we have the S&P, which is up 14.35% year to date. The equal weight is up only 3.42. And what this tells us is that there's this massive divergence occurring where the mega caps, the Microsofts, the Apples, the NVIDIAs have really just taken over control. They've dominated to the point. And what this is telling us is that so many of the other companies in the S&P are actually down. Like, think about this. If you just throw those tech names, those semiconductors, those big names like Microsoft and Apple in this, if you took those out, the S&P would be here at 3.42% or even lower, maybe even negative for the year. And what that tells us is that all the money flow is going into these names, and it puts the market at extreme risk. And historically, when you see this, it is not good news for the next 6 to 12 months.
Can you just maybe make the argument that let's just overweight tech, close your eyes and go away? I've seen those in my comments in some of my videos, right?
Yeah,
I mean, if it's the market leader, why not just stay with the leader? That's one argument.
well, and that's the key, right? Is you could say, let's do that. And a lot of people are choosing to do that. Remember, the bigger these companies get, the more dominant in the S&P. When you put $1 in the S&P now, basically you have 6 companies that are eating up 35 cents of that dollar. And so when you're talking about these ETFs that track the S&P, money just keeps flowing in, because if people are putting them into these ETFs, these tracking ETFs, the S&P, it's going into these names. And what it does is it overweights. But the problem is this: if you go back to 1999, you saw the same thing happening. And what happened to the NASDAQ? It dropped, 65% when we saw the tech bubble collapse. And so when you rely on too many of these companies, number one, it tells us that the underlying economy has a lot of problems. And number two, there's always a reversion trade at some point where people get too greedy. And then at some point, the fear comes in on these names. And that's what I do worry is going to happen.
Okay, another way to look at it is perhaps overweight some of the underperforming sectors right now because they're undervalued, perhaps on a relative valuation basis, or overweight something like the Russell 2000, which has been lagging behind the large caps. What do you think?
Yeah, I think that's one way to do it. In the very least, it's the redistribution, right? It's selling some of the money. I mean, if you have an over allocation now in certain stocks because of their massive gains, you want to kind of pare that back and maybe distribute it through some of the other names. Like, there are some really high value names, like a Zoom Video Communications. Heck, we're using it right now. And if you look at the forward PE, it's trading at a 10 PE. And then you look at some of the other names out there, like a Microsoft or NVIDIA, and you're in the 30s to 40 plus PE ratio. And again, the key is if the growth rate of those names continues, awesome. Then they're going to continue to lead. The problem is, will NVIDIA continually grow by X amount that it's been growing? And we know the law of large numbers, right? I mean, Cisco Systems was a great example of this. They were the main builder of the internet back in 99, 2000. They have never reached those former highs. And I do worry that we're in the same repetitive kind of signature here that we're in with NVIDIA.
Before we continue with the video, I'd like to tell you about the precious metals sector. Now, gold, as you know, hit record highs in 2024. So the question on everybody's minds is, what should we be following and tracking in relation to gold? Well, I'm here to tell you that Stellar Gold is a name to watch. Stellar is a leading gold developer with two cornerstone gold projects in Canada: the Tower Gold Project in the prolific Timmins mining camp, and the Colamac Gold Project in the Northwest Territories. The company has a massive global mineral resource estimate, one of the largest in Canada for a gold developer. Its young and ambitious management team, with a track record of success, is aggressively advancing its projects and is determined to unlock significant value. If you're looking for a team who is as enthusiastic about gold's future as you are, then check out stlrgold.com/David Lin in the link down below, or scan the QR code here, where David Lin viewers can sign up for their Macro Gold newsletter to get inside knowledge and updates for free. Let's take a look at NVIDIA now before we talk about the economy and the other asset classes. NVIDIA has reached a new all-time high not too long ago, and it's been retracing ever since. It has at one point very briefly surpassed all the other companies to become the most valuable company in the world, ahead of Apple, Microsoft, and pretty much everything else. And then after that, it's down about 13% or 14%, depending on the day. So let's take a look at the charts for NVIDIA and what you see there.
Yeah, so flipping to NVIDIA right here, we see that number one, we got a reversal candle on the daily chart. And this is a powerful signal where you gap higher, you make a new all-time high, and you actually close sharply lower on the day. We then had follow through for 2 consecutive days. And essentially what has happened now is you're making what's called a bear flag. Now, just to take you back to history, and we always like to do this, and this is what Verified Investing and myself are all about. I'm all about data, right? Well, if we look back at the previous move, this was an up move on NVIDIA. We got the same gap up and reversal day. We kind of chopped sideways, and then we had as much as a 20% correction before the latest run began. And so these candle formations, these reversal candles here, which we had here for a 20% correction, you have to take them seriously when they come in on a technical analysis basis. So I'm in the camp that, listen, everyone expects the world from NVIDIA, just like they did for Cisco in 1999 and 2000. And the problem is that other companies are already starting to develop chips. Now, does NVIDIA have a huge advantage right now? Yes, but that advantage will narrow over time. Eventually, it did for Cisco Systems, and ultimately, we know what happened there. And by the way, one other amazing stat is when a company is the biggest market cap company in the US, like Cisco was in 1999, 2000, it got as far as 80% above its 200 moving average. NVIDIA just surpassed that 100% above its 200 moving average when it was the biggest company in the stock market. That, again, to me, is a warning sign on a technical analysis basis.
Okay, but why are we comparing Cisco with NVIDIA? They're different companies, different business models, different products.
Good point. Good point. So the reason you compare them is because manias are manias, whether it's the solar mania in 07 that saw First Solar rocket up 1,000%, or whether it's Cisco in 1999, or whether it's the 3D. Remember the 3D printing stocks? I don't know about if you were watching back then, David, but they had this insane run and then they collapsed back down. And so human nature doesn't change. This is why GameStop runs on hype and then gets crushed back down. Greed and fear rule the markets. And so it almost has less to do with the technology, right? The technology of AI, you could compare it to the internet, right? It's going to change our lives. It's going to be monumental, and it will be, but it doesn't stop the mania from taking things up. Bitcoin at 69,000 was a mania. It corrected to 15,000. So manias are based off of human nature. It's actually why psychology and investing and trading is so important. And that's why, in my opinion, ultimately you'll see the ultimate outcome, which is probably honestly a 70%, 75% correction in NVIDIA over the next couple of years.
That's assuming that the fundamentals don't hold up and the company doesn't continue to outperform with their earnings and everything else.
Well, and the question is, this is the one thing I would just say about that is, like, people need to use common sense. They've gotten way out of whack here because it's a mania. And it's like, okay, they absolutely are crushing it right now, and they will probably crush it for the next 3-6 months. But the key is, are literally no competitors going to ever compete with them? And the answer is, of course, other competitors will. And are margins going to stay at 77% when they can sell a chip for $30,000 or $40,000? You telling me margins are going to remain at 77%? 3% like they have the last few quarters? The answer is no, not even close. And that's assuming that we don't see slowdowns in data centers, right? I mean, the economy is clearly weakening at this point. All of these are just things that common sense tells us, but people don't want to believe them right now.
Didn't Sam Altman just create a new version of ChatGPT whereby it's intelligent enough to come up with a business model? And I think he made a presentation.
So sort of amorphous, but it is a business. So I'm just wondering, like, eventually is the idea to kind of like license technologies? Will you have customers that you're going to be customizing algorithms for them, or how is it going to work?
You know, the honest answer is we have no idea. We have never made any revenue. We have no current plans to make revenue. We have no idea how we may one day generate revenue. We have made a soft promise to investors that once we've built this sort of generally intelligent system, basically we will ask it to figure out a way to generate an investment return for you. It sounds like an episode of Silicon Valley. It really does. I get it. You can laugh. It's all right.
I pray it's that easy for all of us. If we can just be like, hey, AI, make a good business, run it for me, I'll sit back myself and never trade again. I'll just let the AI trade for me.
We don't want that now, Gareth. We want you to be trading for us and helping us with some guidance here. Speaking of guidance, all right, thank you for that NVIDIA take. Let's talk about the economy now. What are some of the major data releases you're looking forward to this week?
Yeah, so number one is tomorrow morning, Tuesday morning at 9:30 a.m. Jerome Powell speaks. That's going to be looked at as a cue for what these job numbers are going to tell us. He probably already has the jobs numbers. Is he going to be hawkish? Is he going to be a little dovish? That speech will be a big deal. And then the next report that I'm looking for is 10 o'clock in the morning on Tuesday. That's the JOLTS numbers, job openings data. And that number will be very important. We've seen it really start to come in precipitously here, down to I think about 8 million job openings from 12 million in 2022. Now, historically, that's still above where we were in 2007 before the financial crisis. But if the number comes below 8 million, you now start to get into a reasonable longer term zone where then you can start to say, okay, it's not that easy for people to find jobs. And by the way, just some on the ground analysis. I've talked to people. I have people that I've been talking to that are looking for jobs, and they said they've applied, at least here in Florida, to literally 20, 30, 40, 50 jobs, and they're not even getting callbacks. So things are slowing here. There's no doubt about it.
What about the last month? Apparently the economy added something like 272,000 jobs, more than expected. However, at the same time, the unemployment rate also ticked up. What's your read on the economy adding more jobs, but also more people getting laid off or losing their jobs, or just leaving the labor force, thus adding to the unemployment rate at the same time?
Yeah, so I would encourage people to start looking into the underlying what jobs are being added, because I think they're lower income and they're part-time. And so this is something that the media is not talking about out there. You're awesome enough to kind of bring it to the forefront and let me express it to people. But if you look at the government continues to hire. That's been one of the major driving forces for the economy in terms of adding jobs. And then if you look at full-time work versus part-time work has been going sky high in terms of adding jobs, but full-time jobs are actually in decline. And so these are all precursors. If you look at any of the past, recession periods, this is all a precursor to a recession, to a big slowdown. And I think Jerome Powell's very aware of that, but he can't give an inch right now because you have a scenario where the stock market's at all-time highs and inflation is still north of 3%. So he has to toe the line. He has to play it the hardball way. But ultimately, they're very aware that things are slowing very quickly. They just can't say the pivot very quickly here. And by the way, I even worry about deflation. I even think I was in the camp for the longest time that we'd come down to 3% and kind of hold it there. But I actually think that we're in a position now where we could actually be seeing deflation. And you can only go as far as, just go simply as far as looking at some of these charts. I don't know if you've looked at like the wheat chart recently or the nickel chart, but some of these charts are just downright scary. Let me bring up the nickel chart for you guys. The decline on nickel just in the last 6 weeks, 21%. If we look at other things, oil's holding up, but I heard there was a lot of shorts on the institutional side that are covering, so I think that's part of it. But then if we go to the wheat chart, these charts have just come crashing down, and I do worry that we're actually in for a deflationary period starting not until probably 2025. But if you take the stock market down 20% plus these commodities, I think you're looking at deflation.
I've heard a lot of people tell me that, well, the U.S. debt level is rising. The deficit level is projected to also increase per the Congressional Budget Office, CBO. And thus, the inflation rate will eventually pick back up at some point in the future. This is more of a longer term trend. I just like you to evaluate this and see if you agree or disagree with the notion that just because we have a lot of debt, inflation will not go away.
No, yeah. So this is the kicker. This is how I see it, is that you do have pockets of deflation. My biggest concern, and this is something that I'm literally, it keeps me up at night thinking about, is that you have a government that doesn't know how to rein in spending, and you have a Federal Reserve that every crisis looks for a reason why they can drop interest rates dramatically to stimulate the economy, and also adds literally trillions of dollars to their balance sheet. And so any sort of deflation is going to give the green light, unfortunately, to these entities to just go back printing. And this is how you get to the max pain level, where the debt of the US literally will cause a major, even potentially hyperinflation scenario in the future. Now, I'm gaming this out. This is my job, right? Is I'm a trader. I look at what's happening today, but I also look at what's happening next month, next year, next decade. And I do worry that if we do see deflation, it's going to be the trigger for all of these entities to say, oh, look, we have deflation. Let's just print more money. And that ultimately makes our bed that we're going to have to lay in down the line.
You know what's crazy? If you go to the New York Fed website and you look at the probability of U.S. recession predicted by Treasury spread, I'll put this on the screen for my viewers, but you can do it yourself if you're watching this. Just look up probability of U.S. recession in New York Fed. It's at 52%. Now, it was at 70% last year, but it's at above 50% for more than a year now. That is the highest level since 1981. That is much higher than 2007. It's much higher than 2008. It's just, I just find it bizarre that during 2008, when we had a big recession, the probability of a recession, as indicated by this particular Treasury spread by the New York Fed, was only 50%, or actually, no, 40%. So, yeah. Technically speaking, we are at a much higher chance of a recession than even before, and it's just not happening.
Yeah.
Right.
Yeah. No, and you're right about it. But the thing is, and this can be argued, and I think probably some of your other guests have talked about this, is that one of the reasons why the recession has taken so long to come, and it will come, folks. I'm telling you right now, it is going to come. In fact, I'll argue in a second why I think about half, if not 2/3 of the country is already in recession. But basically what you have is a scenario where the Fed has tightened economic policy quite a bit, but they haven't really gone away. In 2023 of March, they created a lending program for banks that were failing, which was basically unlimited amounts of funds if you were a bank that was at risk of failing. More money into the system. Banks said, hey, listen, yes, this was an emergency lending program, but we don't have to have an emergency to use this money. So let's use it and make money off of it, push it into the system. In addition, you have scenarios where the government, you can argue that the government spending has been negating some of the Fed fiscal responsibility or pullbacks on things like again, monetary policy and so forth. So these kind of combinations have made it longer in terms of coming, but it will come. And I want to show you this, David. This freaks me out here. I know this is something I wrote about this weekend, and this is a headline on verifiedinvesting.com, but shocking 401k plans saw a 40% increase in the last 12 months of hardship withdrawals. Now, again, does that sound like the economy's great when it's jumping 40%? And in fact, from 2021, it's up 100%. That's hardship withdrawals, folks. You don't want to be going into your 401k unless you absolutely have to. The reason people were going into it, the majority reason, was because they needed to save their house from going into foreclosure. Again, if the economy's so great and everyone's making a lot of money, I'm not sure where that comes about. Another stat here, and I have a chart of this, is 90-day delinquencies on credit cards are now higher than they were pre-2008. All right. Again, this is, by the way, as of the last quarter, not as of Friday of this previous second quarter end. So I expect that number to be up even more. And so the problem is you're getting a scenario where the economy has diverged. You have the wealthy that have lots of investments or money that are in, essentially, let's say, savings plans making 5%. If you have $1 billion making 5%, you're doing just fine. If you have $1 billion in the market, you're doing just fine. Even if you have a few million, you're probably doing fine. But the thing is, that's only a small percentage of the U.S. Everyone else is already struggling to get by with inflation and obviously the cost of housing. So things are tough out there right now. And it's again, this is the scenario that all you need is a stock market to correct, let's say 15 or 20%. And that top consumer, the ones that have investments, they're going to pull back. They've been keeping this economy going for the time being. They will pull back on spending and we'll be in a full-fledged recession.
I got a few counter arguments. That first, you were traveling this weekend. Honestly, now, based on your personal observation, does it feel like a recession out there?
Well, if you're in Vegas in the bubble, no, you're right. It doesn't.
Okay.
I mean, it was packed in Vegas. I was in Vegas, right? But I will say this is that if you go to other places, and by the way, I will mention this is the grumblings in Vegas were there. All right. So
Mm,
people were still spending because they're on vacation, right? They're getting away.
yeah,
They're saying, hey, I'm here for 3 days. That's what I did. I was there for 3 days. Let's get a cabana. Let's do this.
sure.
Let's have a good time. But
Yeah.
was I shocked when a burger and fries that basically was one grade up from McDonald's at some of these hotels was $35? I mean, that's insane. And it's certainly, I mean, I have the money, but it wasn't like I was happily paying it. It was ridiculous. And now someone else that has less money, I mean, that's hard. That's ridiculous.
Okay. I like to know where you were staying at, where the burger was only one
Dude,
step up from
all of them.
McDonald's.
I was at MGM Grand, but I mean,
That's
it's
a nice hotel. Okay, look
yeah,
at this.
but that's true. And listen, but I mean, that's the casino, that's the strip
Yeah.
right there, and it's the prices were insane.
Check this out, though. The TSA checkpoint travel numbers. I'm pulling this up. June 30th, 2.8 million. It's up from last year. Every single day this year, since basically, well, I'm just going back to as many quarters as I can this year. It seems to be doing better than last year. More travel activity, more volume of people at the TSA checkpoint. I don't know if they're traveling for leisure or business, but either way, travel's picking up. Is that an indicator of anything to you?
Well, so number one, you could say, okay, yes, the travel numbers are picking up, but then why in the latest quarter did Expedia, and I have the chart here,
Yeah,
Expedia literally collapsed 20-30% on earnings. It has rallied back, but now it's starting to turn back down. So travel companies where they're
interesting.
booking vacations, and this might be to your point, maybe it's more business travel that's going on here because a lot of the travel websites are actually seeing a slowdown here. So great point, and you're making a good point, is that travel, you're right. Airline travel is doing relatively well, but the question is it being done for business travel? Is it because people are back at work and having to travel for business versus staying home? Or is it actually because people are taking more vacations? I'm not seeing the more vacation side of things.
Okay, so how are you positioned then in anticipation of your economic outlook right now?
Yeah, so there's no doubt I'm actually heavily short the markets right now. I do have some longs out there because I think you have to stay diversified. I actually am loving Baidu right now as a long trade. Now, granted, it's a China name, so you got to be a little bit on the careful side. But if we look at this chart, it's been pounded down. I mean, this is basically the Google of China from what I know, and it's trading at almost 52-week multi-year lows down here, and it just tagged this nice little level of support down here. So I think there are pockets. I still like the Brazil markets. It's corrected decently down. I think you have a lot of black swan potential. The dollar yen is one of the biggest ones, David. So I don't know if you've covered this in depth, but look at the dollar yen just broke out above the previous high right here. This is where the Japanese central bank intervened. So they intervened and pushed it down. Then the U.S. comes out and says, hey, they're potentially going to be labeled a currency manipulator because the U.S. doesn't want to do this. And just for your viewers, everyone needs to understand that the reason why the U.S. doesn't want Japan to intervene in the currency markets is because to intervene and strengthen the yen, they have to dump dollars on the open market and they have to dump U.S. debt. They're the biggest holder of U.S. debt. If you have more U.S. debt on the open market, it pushes interest rates up, and that can work against the Federal Reserve in the future. So either way, it looks like they might have to intervene again, though, if it continues up like this.
I'm happy you brought up the yen. Let's keep that screen up there. I heard somebody told me last week the fair value should be 140. Just take a look at the charts. Is that possible? Or
Oh,
is
it
that
certainly
fair value?
is. It certainly is at some point, but certainly, I mean, right now the trend is definitely strong here. You've broken above, so you have a breakout above the previous high. I have a target for my intervention where I do think that they'll be forced to intervene. See the high end of the channel right up here. So if we look, every time it hits here, you get a big sell-off. Right here, you got the intervention. So I think if you get up to this level here, which is right around 163 and change, I think the Japanese central bank will be forced to intervene. And then it'll be interesting to watch how that is a kind of how does the U.S. react to that intervention, because they basically warned Japan not to do it. And then, by the way, not to mention other geopolitical issues, but what's going on in France, we've seen the CAC actually have a breakdown here. I'm going to bring up the CAC chart. And by the way, I don't look at other markets that often, China and stuff like that. But look at the rollover from this high here on the CAC. The CAC is down significantly, basically 10% off of its highs. And the DAX, which is arguably the more important market in Germany, actually broke a wedge pattern and is making a bear flag. So that implies further downside to come in Europe, in the European Union here. So there's a lot of things that are hanging out there, including Taiwan, Russia cozying up to China and then to North Korea. But people continue to say just buy the market, and that's been working up until now. I just do caution people that this was the mentality in previous scenarios before big declines.
The other currencies, though, the euro, let's just take a look at one more currency pair.
Yep.
The euro versus the dollar. It looks like the dollar has been strengthening versus the euro all throughout the year, despite the fact that the Fed has kept rates. Well, I think that's probably why, right? The Fed has kept rates high, and the euro area has just cut rates. So
Right. And I think that's exactly.
Yeah,
I
this
think
interest rate differential, is that going to be eventually weigh down the Fed and make them think, look, it's time to do something about this, or do they not
Yep.
care about the currency?
No, they do. They will eventually. In fact, it almost gives them the green flag. If everyone else is cutting rates around you, it kind of gives you the green flag that you can potentially do that as well. And I do think that's one of the driving forces. When you had Canada cutting rates, the EU cutting rates, you do have what we call in technical analysis a classic wedge pattern on the euro dollar here. And I would just say that in general, watch for which way this breaks out. So when you get wedge patterns, essentially it's hard to know which direction they will go. But once they break, they usually get a big move in that direction. So you would basically watch for a breakout or a breakdown and then watch out in that direction for a big move.
Let's talk about Bitcoin now. Bitcoin has it's just been range bound ever since it broke above $74,000 not too long ago, and then now it's at 62. So it's between 62 and 70,000. This range has been going on for a couple months now. Is it going to break out anytime soon, do you think?
So I still expect a little bit more weakness, but I am a mid to long-term bull. I think, again, the more I see what's going on with the government and the kind of catastrophic spending that shows literally no side wants to get control of it at this point, and then you look at what the Fed is about to do in terms of lowering interest rates, I do think eventually more and more people adopt the idea that Bitcoin is that digital source of safety. Now, it's not right now, but one of the positives about Bitcoin is that the volatility has gone down dramatically. Now, if you're an investor who likes seeing 30% moves in a week, you're not so happy. But if you're someone who looks for a asset like gold, but maybe in digital form, I do think this brings up a great opportunity for a kind of a longer term play. Now, again, my only concern here is that we clearly see the stock market have still an influence on Bitcoin, meaning that if we still see this correction that I do see coming in the stock market, then Bitcoin probably goes down, at least in the short term. I do have a big level at 50,000 right here. This is the former spot ETF approval high, major technical support, downsloping trend line kind of right here. So I think I would start accumulating there, but I have to also be fully aware that if we do get into a full-fledged recession and the Fed does cut rates. Now, by the way, just to interject here, everyone says, oh, when the Fed cuts rates, the markets will go higher. Actually, historically, it's the opposite. When the Fed starts cutting, actually, is when the markets start going lower. So just be aware that if the stock market does roll over 10, 15, 20%, we're likely headed to 50 and maybe even down lower than that. So the basics, just to summarize, I'm a buyer on weakness of Bitcoin because I'm a long-term bull, but I do expect it to get weaker and give me those buying opportunities.
If the Fed cuts rates into a weak economy, that could be bearish for the for the stock markets. But
right.
Let's just for the sake of argument, assume there's a soft landing and nothing happens and they still cut rates. Would that still be bad for stocks?
So my guess is if we have a soft landing, the only thing you get is one or two cuts, and the market will eventually not like that per valuation metrics. I mean, I think the market's already factoring in excessive cuts at this point. And also, again, I would just bring up the former data we looked at in terms of delinquencies, in terms of hardship loans from 401ks or borrowing from 401ks, is that to me, it clearly shows that probably the one thing keeping the economy afloat right now is the stock market. And I do worry that once that has any sort of even a 10% correction, I think a lot of people would pull back on their spending that have exposure to the stock market because they get worried.
In terms of timing then, are you tactically long for now? Like, would you stay, let's say, riding the momentum for now until you see even more signs the economy is turning south?
So for me, I'm a leader in terms of I want to get in front of a move. So I've already shorted the NASDAQ. Like I said, I do have some longs, a little Baidu, a little Zoom, a little, there are pockets where I want to be diversified and have some long exposure. But I do want to just mention here, this is the chart of the NASDAQ 100. And look at this channel. This is again, just like we're looking at, remember we were just looking at that chart of the dollar yen had a channel. Channels are really powerful and they're not used in technical analysis often, but they work. And here's the low from 2020 connected to the low of the recession or the bear market in 2022. And if we stretch a parallel up to this high, the high from the bull market of 2021, we actually just tagged this high here. And to me, that would insinuate some sort of drop. Now, is it a small drop of 3 to 5%? We don't know. But ultimately, I would expect a pullback here. And in addition, The daily chart put in a topping tail last Friday. Topping tails are bearish reversal signals. So it's another signal that could tell us we're on the verge of a pullback. Last thing I'll mention, David, is that the last time we corrected here, this little correction going back to April, it was when, and this is kind of wild, it was when we saw a blackout period for companies just ahead of earnings where they couldn't buy their own stock back. And so here we are, literally, we just entered a period now where we're in this blackout period. About 50+% of the S&P is now in a blackout period. They can't do share buybacks. And again, notice the coordination here. When companies don't buy their stock back, the stock market doesn't do so well. And it's another reason we could see at least a 3 to 5% correction. Then we'll have to see if it expands into more.
If NVIDIA corrects by even 50%, not even 70%, wouldn't that take down the rest of the market?
Oh, 100%, 100%. I mean, it's taken the market up. And by the way, just so everyone's aware here, I just want to show the thesis behind that. So now listen, you could argue that AI is different than the internet bubble. You could argue it that, there's always different narratives. But what I want to show you here is on Tesla. If you go back to the Tesla highs in 2021, what did we do here? And let's do a measurement. So if we look at the decline, we saw a 75% decline in Tesla before it stabilized off of that bubble high. Now you can say, okay, well, that's just Tesla. Okay, well, let's go to Cisco Systems and let's go to the monthly Cisco Systems chart and let's go back here to the chart here of Cisco in the .com era. What did it drop? Let's do a quick drop down here. Basically, you dropped about 85%. Okay, well, that's just one more. Let's go to First Solar. Let's go to the First Solar bubble in 2007 here. What did it drop? 74%, right? So there's this coordination where tends to see these type of corrections when something gets out of favor. Now, do I think that NVIDIA at a 75% discount is a great buy? Yeah, I actually do. Because what happens is at highs, things get overdone because of greed, and then fear takes over at the lows, and they probably shouldn't be down that much. So they'll be buying opportunities. But remember, this doesn't happen overnight either. And I think this is important. A lot of people, they watch these, they're like, oh, Garrett's predicting like in the next month of, no, not at all. It literally will take a year to year and a half. It's about an 18-month cycle. If you look from the high here on the monthly to the low, you're probably talking about 12 to 18 months. But I do think once you start that correction, you'll see NVIDIA correct sizably.
Let's finish off with gold then. Well, gold and the dollar. Let's do gold and the dollar. They're, kind of linked. The gold price has been, again, trading range bound, just like Bitcoin, but obviously different magnitude. So what's your take there on this trading pattern?
Yeah, so the pattern itself right now is favoring the downside in the short term, but continues to be consolidation in the long term. So I talked about this in December with you. We talked about a gold breakout. It happened, beautiful move to 2,400 and change. But now you're in this what we would call consolidation period, and essentially what we've had is this. This is a topping tail. We pulled back, we pierced it, never closed above. I expect us to eventually break this 2280 level and at least come down to about 2190. 2190 starts to get interesting, I think, as a buying opportunity, but I do expect a little bit of weakness before the next leg takes us probably to 2800, maybe even $3,000 an ounce. So I continue to be hugely bullish long term because I think, again, the fiscal issues facing this country and facing the world are a nightmare that isn't going to be easily fixed. And gold is one of the answers, and eventually Bitcoin will be the other answer.
And then the dollar, we talked about other currency pairs, but the DXY just continues to, hang in there, despite what may appear to be a weakening economy. And I've heard this from actually economists who are bullish. They say the economy is slowing, not necessarily flat out collapsing, but just slowing. Anyway, the dollar is holding strong. What's your take?
So the first thing to remember is the U.S. dollar doesn't have as much to do with the economy here as what's going on with other currencies, right? So the fact that the yen is weakening, the fact that the euro is kind of stabilized, but again, the dollar's holding up. A lot of other currencies, because these central banks are cutting rates, their currencies are weakening, which is keeping the dollar stronger. If the U.S. starts cutting rates aggressively, then the dollar, you would assume, would start to fall. But right now, remember, the dollar is against all a basket of currencies, and those currencies are weaker, and that's keeping the dollar strong. On a technical analysis basis, we have a very clear potential breakout, but it's not yet done. Above 106.20 would be a breakout. That could actually take us as high as 114. On the other side, if we break 104, you're likely going to about 101 to 102. So again, this is kind of a range bound. You can see it's just up, down, up. Let's watch to see which way it breaks. I eventually think the dollar does weaken, but again, it's a basket of currencies. So if everyone weakens more than us, it'll keep the dollar relatively strong. The US dollar is still the cleanest piece of laundry in a dirty hamper, if you will, or whatever analogy you want to use.
Plenty of more things to discuss next time, but we're out of time to take care of that. I wish I could talk to you all day.
Oh man,
Where
there's
can we,
so much to talk about. There's so much to talk about.
where can we find you? Actually, you know what? Let's address some of the hater comments. One of the comments is you're early on your shorts, the timing is wrong, but you're still sticking to it. Your conviction is high. How do you respond to that?
Yeah, so the absolutely correct. So definitely early on it. I think that's part of being, a trader, investor. You see the future and you start positioning yourself ahead. Just a good analogy, or actually a good point. I had some people that I was trading money for back in '07. I warned them in early to mid '07 to be exiting the market in full. We didn't start to decline until early '08. And so I was about 6 to 8 months early there. I'm probably 6 to 8 months early here as well. But ultimately, what is the writing on the wall is there for everyone. I mean, that's the thing, is like, you can't deny it. We can kind of put our head in the sand, but it's going to happen. And it's better. I'd rather miss some upside than be caught with my pants down on the downside.
Why don't you just stay out of the markets, like just cash?
Yeah, I'm a trader, though. You know how I am. I'm a swing trader. I'm in and out so much. I mean, again, do I have a lot of longer term positions? No, but ultimately, I think that it's good to be positioned. Like, look at Michael Burry, right? He positioned himself ahead of it, and he ended up making so much money when what he predicted occurred in '08. I'd rather be in that position and really make the big money at that point as well.
It's a good. We'll finish off here. It's a good example of Michael Burry because he had to pay a lot in basically credit default swap premiums before the whole thing collapsed. And so his investors were like, dude, what are you doing? Get rid of this. Like, you're losing money for us.
Yep.
And he held on to it, right? And he turned out to be right.
It's not easy, David. I'll say this. It's not easy going against the group and the masses, but you ultimately, if you know what you're doing and you're reading the charts and the data correctly, you ultimately will be right. Michael Burry, great example there.
Okay. Do you stop losses right now?
Yeah, so on certain things, if it's a bigger macro play, then I'm just letting it do its thing. That's fine with me. I don't mind allowing it to breathe a little bit. But if it's a shorter term trade, absolutely.
Okay, where can we find you now? Oh, you're all over the place, but where's a good place to find your work?
Verifiedinvesting.com. It's a place where we're data driven. It's all about charts and data analysis. We have lots of other traders joining this website. All the homepage has amazing content on there for free, heat maps and earnings and economic data and chart analysis, all free. And then we have courses where we teach people how to trade, trading room for day trading and swing trade setups as well. So it's really meant to be a place where I want to draw the best in the world. And that's one of the reasons why I love interviewing with you. You are one of the best in the world, David. And I'm sure in comments, people will agree with you on that.
We make a good show. So I appreciate you coming on the program. Next time we'll talk about more stuff. I got to go, but thanks for being here.
Thank you so much, David. Take care.
Thank you for watching. Don't forget to follow Gareth in the links down below, and we'll see you next time.